Hello class, my name is Beau and I will be presenting on GASB 34. GASB stands for Governmental Accounting Standards Board. It was established in 1984 and their job is to establish accounting and financial reporting standards for the U.S. state and local governments that follow the Generally Accepted Accounting Principles, or GAAP. GASB Statement 34 was issued in June of 1999 and it deals with basic financial statements and management's discussions and analysis for state and local government. The rules require governments to provide basic financial statements using government-wide approach. GASB 34 says that government-wide financial statements should be prepared using the accrual basis of accounting. Government fund financial statements should be prepared using the modified accrual basis of accounting. Now I'm going to work a problem for you guys from a solution I found from Professor Farhart. The problem compares modified accrual accounting versus full accrual accounting. And then these are some of the sources that I used during my presentation. Switch over real quick. Okay, so this is the example I found from Professor Farhart, and the Preston Village engaged in the following transactions, and I'm going to go through and fill out the transactions from the modified accrual method and also for the accrual method. So the first example is the Preston Village issued $20 million in bonds to purchase a new municipal office building. The proceeds were recorded in a capital projects fund. So under the modified accrual method, we're going to go ahead and debit the cash for $20 million, and then we're going to credit the proceeds from the bond for 20. Then over at the accrual method, we're going to debit cash for 20 million, and then we're going to have bonds payable because it's a liability that the company has of 20 million, so we're going to credit that. Okay, then moving to the next one, it says it acquired the building for $20 million. So under the modified accrual method, we're going to have expenditures whenever we owe something. So we're going to have an expenditure of the building for 20 million and then cash for 20 million as well. Okay, so under the accrual method, we have the asset, the building, so it's going to be $20 million for that. And then we paid cash for $20 million, so we're going to credit that. Okay, moving over to the third example, it recognized as appropriate $300,000 of depreciation on the municipal vehicles. So under the modified accrual method, we're not going to have a transaction on this one because there's no long-term assets, so therefore we don't need a transaction. And then moving over to the accrual method, we're going to have a depreciation expense of $300,000, and then we're going to have a credit of accumulated depreciation from the $300,000. So we're just simply moving the depreciation down into the expense down into the accumulated, where we have the other amounts that is depreciated already. Moving on to the fourth example, it transferred $2,060,000 from the general fund to a debt service fund. So under the modified accrual method, we're going to have two different transactions. For the general fund, we're going to debit, transfer it out to debt service, and then we're going to credit cash. And both of these are going to have the amount of $2,060,000. So basically, we're moving the cash out of the general fund into the debt service fund. Okay, so for the debt service fund account transaction, we're going to have cash debited for $2,060,000, and then we're going to have a credit of transferred in from the general fund of $2,060,000. And then moving over to the accrual method, so technically we don't have any money coming in or out, so therefore we're not going to have a transaction underneath the governmental-wide financial statements. Okay. So for the fifth problem, it paid $60,000 in interest on a long-term debt and repaid $2 million of the principal on the same long-term debt. So we're going to have an expenditure of the $60,000 that we paid, and we're also going to have an expenditure of the principal, or the bond, of $2 million. So with that, we're going to have a credit of the two combined, and that is going to be $2,060,000. Moving over to the accrual method, we're going to have an interest expense of $60,000, and then we're going to have a bonds payable because it's a liability that we have incurred of $2 million, and then we're going to have the same cash credit of $2,060,000. And then the last problem we have is it sold for $5 million of the village land that had been acquired for $4 million. The proceeds were recorded in the general fund. So under the modified accrual method, we're going to have cash of $5 million because that's what we sold it for. And then we're going to have proceeds from the sale of $5 million as well because that's what we got from the sale. Okay. And then under the accrual method, we're going to have cash of $5 million, which is how much we got from the sale. And then the land, we acquired it for $4 million. So the difference between the 5 and the 4 million is 1 million, and that is the gain that we have received from the transaction. So yeah, those are just a couple different transactions and the difference between the modified accrual method and the accrual method for each of them. So that's all I got, and thank you very much.